I'm here on the floor of the New York Stock Exchange with Jim Cramer, who's going to answer your Twitter questions. Jim, lots of questions today, but I gotta ask you about all the action on the floor, and that is the Fitbit IPO.
Okay, Fitbit IPO is a lot different from what I hear people saying. This is a very profitable company. It's had remarkable growth. It is not one of these companies that has said, you know what, we're going to sacrifice earnings because the opportunity is so great. They've always cared about profitability. James Park has been a remarkable CEO. I've been able to follow him and interview him before. Just in terms of parameters, it's between 35 and 40. This stock's basically being valued at a little bit less than GoPro. And yet I think that it's a little bit bigger than GoPro, given the numbers and the actual uptick of the device. So I'm blessing between 35 and 40. $38 is an okay price. Why? Because next year's earnings, I'm using trailing earnings, next year's earnings, the PE is going to turn out to be much lower. And that means that this is a real company. I know people are very concerned that Apple's going to come in against it. I actually believe Mr. Park when he says that the category is bigger than that. This is a wellness story. Health and wellness, maybe still the biggest story running through the successful companies, whether it be biotech, natural organic food, and devices.
All right, Jim, now we'll move on to our Twitter questions today. What are your thoughts on the son of Salesforce, cloud company ServiceNow?
No, I like ServiceNow very, very much. I like Tableau Data and ServiceNow. I totally get why you would want to own them, and I think that they're great momentum stocks. ServiceNow is a very good company.
How about Cree at $30? You've talked about it in the past, it rallied, now what?
That's the opposite of ServiceNow. ServiceNow is a company that has tremendous growth, and it's really become integral to a lot of different companies. Cree is, I'm not saying it's an also-ran, because then someone will say, well, Jim, you know what, it's got a takeover bid. But they have technology, OLED technology, it's okay, but it's not breakthrough. And it's not something that's being clamored for anymore.
We haven't talked in a while about Facebook. What do you think about the valuation currently?
I think Facebook could earn $350 in 2 years out, and therefore I think that you're paying a very inexpensive price for it. A lot of people feel that's ridiculous. A lot of people feel, the other day I said that maybe WhatsApp's going to turn out to be a bargain. Go back to the conference call when Mark Zuckerberg said, listen, we spend $19 billion not to be able to monetize this thing. Zuckerberg's much better than people think. That company's amazing.
How about 3D printing companies? How do you play them?
I still want to stay away from them, and I want to stay away from VoxelJet. I want to stay away from Stratasys. I want to stay away from 3D. Why? Because HP is coming in, and they have a very good 3D model, and I've seen their product in action. I think it's better than all these guys.
And Jim, finally, do you think Google should take its big pile of cash and buy the car company Lyft, another car that you get on your app?
No, Google should buy Twitter after an activist gets involved with Twitter and then puts the company up for sale. The problem is activists don't like to go after companies that don't have earnings. Twitter doesn't have earnings. But Twitter has a power vacuum at the top. Google has a power vacuum in social media. Google could fire everyone at Twitter, and that's why I say if Google were to pay even 50% more, their stock could go to 700. But Google has historically not been able to figure out what to do with that cash. I've now come up with a plan that moves the stock.
Jim Cramer, always good to talk to you. I'm Rhonda Schaffler on the floor of the New York Stock Exchange. Remember, send your Twitter questions to Jim at #CramerQ.